back here with Omar. My special guest today is the life insurance mercenary, Darwin Roman. Darwin and I know each other for about 4 years?
Yeah,
okay.
Going on that now.
So we met 4 years ago. We both founded chapters of a certain organization, and we left them successfully, and we still remain friends. He's one of my financial advisors, and I wanted to bring him on to discuss a few things. Darwin, anything you want to say first?
Well, first of all, thanks for having me here. It's good to see you.
Glad to have you.
Actually, we were joking about it before, losing track of time. We said 4 years, almost trying to figure it out because this year was kind of crazy. And we don't know if it's been.
This year still is crazy.
It could be 10 years at this point. We don't know. But it's good to see you again. It's good to see that we're all healthy, and I'm definitely blessed to be here and be able to share some knowledge and information with regards to building wealth.
We're talking about building wealth.
Yeah.
So I think that's the big thing. I think everybody gets in love with the fact of maybe making a lot of money. I think people kind of they lose sight of the fact that once you reach a certain level, your expenses tend to crank up a little bit. Mm-hmm. And then, for my big thing, so really this podcast is kind of really for me because I'm always planning ahead. How do we ensure against, I'm the primary producer for my family. Like there's a lot of people like that. How do you properly shield or protect somebody in whatever level, whether it's the beginning or the middle or they've reached a certain financial status? What's the plan? Like, what do you do? What do you look for when you sit with somebody? Like, hey man, let's take a look at everything. Tell me, give me an analysis.
Sure. I'd say I look at it, and maybe using a football analogy would be the best way to go about it. It's about offense and defense.
Okay.
Right. So I look at your strategy and say, okay, listen, the end result, it was trying to get to the end zone. We're trying to win the game. Right. So I say, all right, Omar, you're the owner of your team, right? Mm-hmm. So what do you have in place as a strategy for your offense and your defense so you're going to win your championship? Okay. And then we look at that strategy and say, how has it played out so far? Right. Because as we know, football teams change coaches after a while, change quarterbacks, right?
So, eventually change ownership.
And change ownership.
If it's that bad, yeah.
So we look at that and say, okay, because eventually we want to make sure that this strategy is the right one to be able to achieve what you're looking to do. And it could be achieving peace of mind, right? It could be the first thing is saying, listen, I want to make sure on the defensive side that if something were to happen drastically, whether it be an unexpected death or disability, right? We want to make sure we protect that because you're the owner of the team and you want to make sure that the rest of your family, right, the rest of your team is going to be financially protected. So that could be one of the conversations where we start.
Okay. And that right now what we're talking about is like life insurance.
Sure.
Right?
Yeah, life insurance. Sure.
I was thinking about this. Like, let's say, and I'm just throwing numbers out. Mm-hmm. Let's say I have a net worth of $1.2 million, right? Mm-hmm. Just based on that number, what kind of life insurance do you recommend to somebody?
Sure. I would say I look at the net worth as a way of saying, well, how liquid is it? Because we look at, in order to really calculate the right amount of life insurance, we want to make sure you're doing a P&L, right? You're doing your profits and losses in a way or assets and liabilities, right? And we look at it and say, okay, let's pretend you didn't have life insurance and you have all these assets. What will we tap into first in the event of an emergency, right? Let's say if something unexpected happened.
Liquidity, like what could
liquidity,
we,
right?
What can we grab?
And then we say, okay, but we needed a certain amount of protection. How much of those liquidity assets will cover that protection? If there's a gap, then hey, you know what? How do we protect that gap now? Now it's a life insurance conversation to have. Okay. Because some people say, well, if you're ultra wealthy, you can be self-insured. That may be the case. Right. That may be the case. But then we say, well, listen, then if you're ultra wealthy and you have a high net worth, well, then we have to talk about how we preserve that wealth.
It's about shielding your assets.
Right? Because then at that point, it's a different conversation. Right. So it's all based on the individual. So whether the person has $1 in their bank account or $100 million in their bank account, it's about finding the right strategy that makes sense for them so that we're using whatever they have in place and then either expanding that or enhancing that.
Okay.
Yeah.
All right. So I'm talking about HRN right now in terms of the real estate platform. Sure. So what I'm thinking about doing is offering new agents a few things. One of them is life insurance policy. Okay. Right. Life insurance policy for, let's say, $100,000. Okay. What would that cost me as an owner, and is that tax deductible?
So when a company offers, what you're asking is basically an employee benefit or a fringe benefit. Right. A fringe benefit is when you as an employer would actually absorb the cost of that benefit on behalf of the employee. right? So you as the employer would receive a tax deduction on the company side because you are spending your dollars to provide a benefit for your employees. As the employee, obviously, it's a retention tool, a rewarding tool, because they see that, hey, listen, as long as I'm employed here, I have this coverage with you, which is great.
Yeah.
So it benefits both parties in that sense. And for you as the owner, sure, it absolutely will be a benefit on the back end for your company.
So my big thing right now, I know that there's a million real estate companies like EXP, Delta Settlement, all these big time places. So I'm more of a boutique shop, right? And right now I'm like the main producer. What I'm looking to do is offer my agents that might come on life insurance. What other ideas can you give me as a fringe benefit to offer agents besides, marketing and coaching and stuff like that? Because everybody kind of does that. I'm just really trying to change the way that's done.
Sure.
What ideas would you be able to give me to give agents that are coming on?
So, and I would say, as a company owner, let's go back to the life insurance conversation for a second.
Okay.
So, yeah, you can structure it that way where it's a kind of a blanket issued policy that covers the employees for protection purposes. But there is a way where you could structure life insurance plans as a bonus arrangement. So, for example,
Talk about that, yeah.
let's say you have a top producer. Matter of fact, let's go back to the football analogy.
Okay.
So, Jim Harbaugh is currently the head coach for Michigan, right? So, part of his compensation package is this bonus arrangement that he has with the university. That bonus arrangement is actually funding a giant life insurance policy for him. In the event of his death, his family will get that benefit. But there's a restriction where he has to serve a certain amount of years as coach of the university for him to be able to get that policy and him walk away with it. In the meantime, the university actually owns it. It's their policy.
So they're the insured.
So they actually the owner of the contract. He's the insured, right? However, once he fulfills his obligation of service that they agreed upon, they will then relinquish ownership of that contract to him, and whatever values have been built in there, and also the death benefit that's grown over time will be his.
And that becomes a liquid asset?
It can become liquid. It's his at that point. And the point is that it was highly subsidized because basically the university paid it on his behalf with the agreement that he would be the coach. Right. So the same thing could happen here. You could any business really could. It's called an executive bonus arrangement. And what you're doing is you're taking dollars and you're funding, let's say a life insurance contract. Now, why a life insurance contract? Let's also go into that part, the legalities of it. Because when you have a company and you offer, let's say, a 401k plan, right? That's a qualified retirement plan, but also has a lot of rules around it, ERISA rules, non-discriminatory. So, for example, you have 10 employees and you have a 401k plan you're going to put in place for your company. You can't discriminate and pick and choose which employees get to participate.
They all have to participate.
You have to actually make it available for all of them.
So they don't have to.
They don't have to.
Okay, but
you have to offer it to them.
Okay.
You can't just offer it and cherry pick your top producers. Say, hey, listen, I'm going to match your 401k. Come in. No, that's illegal. However, because it's a qualified retirement plan, a non-qualified retirement plan, I'll explain what that means. The difference is a non-qualified plan in general is actually, let's say, life insurance, right? So you could make that arrangement where you reward, let's say, one of your top producers, top realtor, top loan officer, whoever.
Top whoever, guys.
Top whoever.
It's anybody, right? Anybody.
So you're a business owner, you have talent on your team, and you want to keep them on your team. You could then use the life insurance policy, structured properly, as a way to be able to give them an incentive to stay with you. Because that policy will build in value over time, and they can walk away with it. But you as the owner get to set the rules on how. It's almost like saying, hey, listen, top producer, do you like Ferraris or Lamborghinis? They go, Lambo. Okay, I got a Lambo for you parked in a garage in New Jersey. We're in New York. However, and I have the keys in my office. As long as you stay with me for 10 years, in 10 years, I will give you the keys to that Lambo. In the meantime, though, you got to keep producing. Keep producing. Do what you do, right? But in 10 years.
And you can set minimum criteria?
Yeah, you get it. In 2030, when we agree that, hey, yes, you do your service, thank you, I appreciate it. At that point, you decide you want to go off on your own, open up your own shop, whatever. The keys are here. They're here for you. The Lambo's yours. You can walk away with it. That's the idea you have behind it. That's kind of the mindset of it.
I like that. What about also go into how life insurance policies, if you fund them right, can become annuities?
Right. So it's similar to what we're talking about here.
Okay. So let's expand because I don't think people. There's a lot of ways to make it work.
Right.
And people don't really know.
So what you're doing is you're leveraging the feature was called cash value buildup in a life insurance contract. And the way I explain that to a lot of people is using an example of a home, right? And a lot of people ask me this very basic question. The difference between term insurance and permanent insurance, also known as whole life insurance or universal life insurance. People always ask, which one is better? Or which one sucks? Or which one do you not want to do? My explanation is very simple like this. Term insurance is a term of time. Eventually that term of time will expire, right? And term insurance is like renting. It's like renting an apartment. And I tell people, listen, coming from the real estate world, right? When you're a renter, not a bad thing, because the worst thing would be homeless, right? So you got a place to live, sleep, eat, cook, right? You have shelter.
Quality of life.
Sure, you have shelter. And then when you stop renting after 10 years, and you maybe decide to become a homeowner, congratulations. But understand that obviously that rent, that apartment you've been renting for 10 years doesn't belong to you at that point.
For use.
Just for use.
That's a great analogy.
It's just for use. And there's no equity in there, right? It's not yours. Now you become a homeowner, You become a homeowner, and now you're putting dollars into a home.
So not only you're enjoying your life, now you're building equity.
Correct.
Right?
And now you're building equity.
That is what? That is what type of insurance?
Permanent insurance.
Permanent. Or is it whole life insurance?
Well, yeah, permanent comes in two different flavors, so to speak, whole life and universal life. But permanent insurance cover is the general term of those type of policies. Permanent. So permanent insurance is like buying a home, right? So over time, you're building value in your home. You're building equity. Same thing happens in a permanent insurance policy. And typically, when people say, well, what's the differences in price? How much? People always ask me, how much does it cost? I say, listen, there's a difference here in the sense of cost versus contribution. There's a big difference. So I also say, well, I speak to realtors all the time, right? And I say, what's one of the biggest objections you get from a renter of not buying a home? In their mind, they think, it's more money out of my pocket. I could come up with a down payment. I gotta maybe now worry about maintenance on my end, worry about the backyard, something breaking. That's on me now. And that and as a renter, I see more dollars coming out of my pocket. And then as a realtor, you say, true, you're right, that could happen. However, the benefit of being a homeowner is boom, 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 right? There's a lot of benefits to it. So the same philosophy applies to the permanent insurance policy. Now, and of course, it's all based on the person. I don't automatically go with that recommendation.
Well, it depends on where financially or where professionally they are, right? If they're young family, it might not be the right time, or they want to buy a house.
Correct.
You got to take all that into consideration.
Which is what an advisor should be doing. And that's one thing I like to point out is that when it comes to working with an advisor, an agent, they should be looking out for your best interest. I actually just recently won a client away from another advisor. And actually, based on the fact that this advisor happens to be a family member. They're brothers.
Oh boy.
But the one brother who's younger is new to the industry. Apparently this brother's manager is kind of really putting pressure on the brother. Yes, to actually put a certain amount of money into the product. And the brother, the prospective client is like, well, that's out of my budget. And they're not really listening to the client. So the client gets annoyed.
Small technical difficulty, but we're back. And we were talking about winning over a client because what again?
They weren't looking for their best interest. And so
the other financial advisor.
The other advisor wasn't looking for their best interest. And so when it comes to going back to the idea is that they should look for your best interest. They're saying, and going back to me, I've had a client, they said, my goal this year is to buy a home. I said, well, great. So you need to start putting dollars away, saving up for your down payment. And they were saying to me, yeah, but I really like this permanent idea. I want to put dollars in there. I know I can. And I said, I know you can fund it. And I know it's a great strategy for you. It'd be perfect. But your goal is to buy a home. Your goal becomes my goal. So I, in good conscience, can't say you should put a certain amount of dollars away into this, where I know you need to start putting cash away for your down payment.
Did you ask them to lower?
I asked them to lower. I had to lower. I had to basically talk them down from putting money away. Because I want them to get that home. I said, that's your goal is my goal. I said, listen, don't let this product romance you away from your dream. I said, this is important.
Get the house,
but get the house. I said, because imagine the tax deduction you're gonna get. I was like, all this stuff, I know the benefits of buying this home. Buy the home. I said, I'll be happy. Listen, when you buy the home and we get through that, we can talk about this again a year from now. It's okay. I was like, just get it done. He's like, you're not losing anything by waiting a year. You're starting now. You can fund this more later. It's okay. And that's the right way to go about it. So if an advisor is maybe steering you a little hard, and I think that's any profession, they're not looking out for your best interest, look for somebody else.
When do you think is a good time? I think my answer to my own question is probably like every 6 months. But when do you think is a good time for clients to reach out to you to whether they're established clients or maybe thinking to be clients? when is a good time for them to reach out to you? Like, when is a good time to speak to a financial advisor? Do you need to have a lot of money?
Well, no, you don't need to have a lot of money, number one.
Okay.
Because obviously you have to start somewhere, right? That's number one. To answer the question about when is a good time maybe to reach out to an advisor, it's better, the way I see it, it's better to be proactive than reactive. So for example, it's better to have the fire extinguisher before the fire.
Right. I get you.
You're better off that way. Because at that point, you're going to save yourself a lot of trouble, a lot of headache, a lot of problems.
Okay.
And when it comes to now, let's say you do have an advisor, an agent you're working with, or a professional you're working with, reviewing what you're currently working on, or what you currently have with that person is good to do. Some people like 6 months, but at least on an annual basis, just even checking in. And I do annual reviews with a lot of clients to touch base with them to see how they're doing. Sometimes there's nothing to discuss. Nothing has changed. Everything's good. Okay, hey, listen, how's the kids? How's the family? How your parents doing? This year was more about how's everybody's health. That was important now. And they say, thankfully, everybody's good. We're good. I have my job. I said, congratulations. Hey, you know what? When this whole thing is hopefully over soon, let's talk again next year. Maybe I'll come see you, right? And that's it. And sometimes the conversation goes a different way. They say, oh, actually, things have changed. I now have another child, or maybe it's a bad thing. Maybe I'm getting divorced. Who knows? Those changes then trigger a need for some more counseling, and that's where the conversations annually.
Here's a funny question. I just thought about it when you just mentioned that. All right, so let's say somebody's getting divorced. Right?
Okay, here we go.
And
this can happen, by the way. A lot of pandemic.
Listen, real life stuff.
Divorces will happen.
All right, so check this out. Here's a question, and it's not because of me, because I'm super happily married.
Yes,
okay? Remember that. So let's say you have a couple that is a client, right? Yeah. And then you have, I'm just going to throw numbers out there. You got $100,000 in retirement accounts, $2 million in life insurance. How do you, is it okay for you, like, if it's under both their names, how do you divvy that up? Is that legality wise? How does that work? Because I think that's a real question.
It is a real question. Okay. It also, to go into the legality of it, what happens when you're going through divorce, though, based on your state, they'll have certain laws of how to divide marital assets. Okay. So that's going to be a big part. Okay. I have worked with divorce attorneys because those issues come up, and so now they may have to split the assets. Right. And let's say it's an IRA that has to get split. Now the one spouse gets the part, the other one, they split them, and now this other spouse, let's say, doesn't have an advisor to work with. Now they have somebody they can work with, possibly us, my firm, or my team. But with regards to what happens after that, ends up becoming more of a legal question, because the laws in the courts will then see.
Well, here's the question. All right, so here's the question. You meet John and Jane. They become your clients. You love them, whatever. They're getting divorced, though. You know, John or whoever, somebody was at fault. Doesn't matter who. Sure. So how do you determine, or can you keep both of them as clients after you split their assets?
You try to. Okay. You try to as much as you can. You try to be neutral. But it might not be easy, especially if there was more of a personal relationship there. Right. Let's say it's actually one of my. Let's say it's
a really intimate business.
What if it's one of my boys, right? Yeah. And then I'm like, I was like, okay, do I talk to your ex now? What do I do? And I think it's more of a friend conversation. So listen, talk. Let's say we're friends, and listen, is it okay to keep working with your ex, or do you want her to work with somebody else? It's cool, like somebody else from my office.
Yeah, that's a real
whoever or someone else.
That's a real conversation.
It's a real thing. It happens, and so. But I think it's more of a being authentic and transparent with the people at the table, and say, listen, we have this working relationship. This relationship is not going to work anymore between the two of you. However, where does that put me, right? And then from there, you kind of go from there.
Okay. Yeah. So here's a question. I have 3 financial advisors. Not that I'm rich, but
a team. It's good.
I have a team. What's the difference between, let's say, and I'm just going to use names.
Sure.
A Morgan Stanley advisor, a True North advisor, a MetLife advisor, if they're still around. I think MetLife got bought out.
Yeah, Mass Mutual. Bright House Financial.
What's the difference between those 3 guys? Like, if you can clarify for me as well as the people listening, because you have so many different names out there, you don't know what's really good, what's not good.
Right. So you're going to have, I would say, 3 different types of professionals in this industry. Okay. One that's mostly a wealth advisor. Okay. Second one that's primarily more like a risk manager, like based in more insurance-based products or insurance-based mindset. Okay. And the third is more of a overall holistic financial planner. Okay. And you might see out there some professionals that have the designation of CFP, right, which is Certified Financial Planner. Right. Those professionals are in a different category because they're pretty holistic in the sense of they can do either of those, either plan they can do.
Any of them, right.
And they're at a level where some advisors also their fees are different in the sense of a wealth manager, for example, could take on your IRA. There's going to be a management fee attached to that
Every year or something like that?
every year, for
Okay.
example, as some let's say certified financial planners may not charge an actual fee. They may charge some kind of retainer because they can. Because I mean, there's some planners that because of the designation, they can say, hey, listen, as we sit down and talk today, you can take my recommendations or not. However, my time I will bill you for my time.
Right, I still get paid.
Yeah,
Whatever
which
you
can
do,
happen.
doesn't
So
matter.
so people that know that there are differences. So but it doesn't mean that one will help you better than the other. I think it's good to have a spread of different opinions because then from there you'll get more value out of everybody's think tank, I call it.
Okay.
Because everybody has a different approach too.
Right.
And sometimes also there's different disciplines that some advisors have that others don't. So for example, compare myself to the Morgan Stanley advisor that can definitely tell you, hey, listen, the next big pharma stock will be this. I definitely advise you today to
Get into
because
that.
he or she is watching the Dow Jones today, right now, screen-wise. I'm not the person watching the Dow
So
Jones. every day.
where do you fit in those three?
I would say more on the risk management side for me.
Okay.
Because I say I look more long term. I look at the more of the defensive. I said, listen, I'm talking about things go wrong. Where's the armor? Where's the armor? And in this year with COVID, I believe it brought a lot of awareness in that sense.
Did you have a lot of claims?
You know what? No.
Okay.
Thankfully, no. And I know that people got scared. What I did have actually that was the reverse. I had a lot more applications.
Yeah, everybody want to get insured.
People got applications.
Yeah.
And because it did affect the industry to a degree, some of the carriers at some point were kind of shrinking their market and not allowing some people to even
But
apply.
I see you post a lot of stuff on Instagram about people not even have to take physicals for certain
Sometimes,
policies.
yes. Now that's also been a side effect of COVID. Also, a lot of companies going through a different way to underwrite clients, where they don't have to necessarily be examined, at least not up front at the moment. If they can gather enough information about you based on different databases like your medical information bureau, your motor vehicle report, your prescription history, and they can get enough information just based on that, they can tender an offer.
Wow.
Based on that.
So they have access to all that.
Right, correct. Right now in New York, it's a little limited compared to other states. So for example, most carriers in New York may go at most $1 million to offer without necessarily seeing somebody for a physical exam.
Okay.
Other states will go higher, but New York's obviously its own individual kind of playground.
So what advice would you give somebody who is starting their business, maybe he's getting married, like what would you tell them? Hey man, should you get insured?
Sure. Well, I say it this way because they're at the beginning crucial stages, and we both know what that's like. The beginning crucial stages of building your business, building your empire, and the last thing you would want something to go wrong. Anything can go wrong at any given point. So I would say that a person looking at their business plan and saying, okay, you have a 3-year business plan, a 5-year business plan, a 10-year business plan. Where in that business plan is your risk management part? Because we also have to know that, let's say, for example, you just opened up a restaurant and you're the owner of that restaurant. Well, that restaurant rises and falls on you as the owner.
Right.
So you're the key person in that business. We got to make sure that you, the golden calf of that business, is protected. Because if that falls apart, then everything else it's a house of cards. It just goes right under. Especially if you're having also a family and they're depending on your income, it's important. And also, if you're switching, right now there's so many people out there watching this that maybe have been career changers or are becoming business owners for the first time. Especially entrepreneurs.
New sexy name.
Yeah, entrepreneurs. Especially now when maybe they notice that the way the economy's been going and the labor market's been going, they're better off working for themselves than working for somebody else. But now the responsibility of putting all those benefits you were used to, the dental, the health, the vision, the medical, the life insurance, all that now falls on you. Right. So now you have to be your own HR, your own benefits person, your own advisor in that respect.
Yeah, there's a lot
but you
of
can do it.
responsibility.
But you can do it. It can be done. It's just a matter of now looking for an individual person like myself and say, listen, now I'm a business owner, but I need to at least get some basic stuff in. What's the basics I should at least have in the meantime? Right. And then that's when we talk about disability insurance, life insurance, major medical insurance, dental, things like that we start putting in place for that business owner.
Good to know. Also, I've heard this in the past, but you can confirm or deny it. I've heard that when people start businesses together, partnerships or corporations, whatever, usually the partners insure each other.
Correct.
Right.
Correct. That's a good point. Yeah. So that's what's called a buy-sell agreement. So let's say you have two partners, right, in a business. And so if you set up an LLC or a corporation, that's a legal document that says you're both partners in this business, you both have equal shares. In the event of a death, what can happen, we talked about divorce, well, there's also death, right? And so when divorce or death, there's gonna be a share of marital assets. Marital assets include business ownership as well. Right. So that may mean, for example, hypothetically, you and I start a corporation, we have a business, I'm married, hypothetically, right? And I pass away. That now means that legally my spouse can now step in as in my shoes as now your new partner, right? And she may actually be a really great makeup artist, have nothing to do with real estate.
Right.
So then that's going to be a problem.
So the life insurance would be like, oh, well, listen, we had this value.
Correct.
Here's your buy. This is your share of the company. So now the company's 100% mine.
Correct. Okay. So then we have the buy sell. So now my surviving spouse will then sell her share to you, and you will buy that share leveraging the life insurance proceeds, and as opposed to coming out of pocket.
Right. And how are you paying for that? Is that from the corporation?
It could be from the corporation.
So that's cool. Yeah, it actually works. That makes a lot of sense for a lot of different reasons.
And then you want to, and also to add to that, you want to add in an attorney with that, because that also becomes a legal document that you want to put. And there's different types of cross buy-sell agreements and also cross purchase agreements as well, it's called.
Okay.
So whether the entity actually purchases it or individuals purchases it, that goes case by case, and that's when you want to get an attorney involved as well.
Okay. And every state is different.
And every state is different. Right. So that's why the attorney comes into play. I can put the funding in there, but the actual arrangement legally,
and the execution, all that.
Gotta get an attorney. Gotta get an attorney.
That has to be legal. Okay. So, quick question for you: if somebody wants to reach out to you, what's the best way to reach you?
Sure. Well, I'm definitely heavily on social media. You can find me at Life Insurance Mercenary. That's life_insurance_mercenary. On Instagram. It's kind of long, but you'll be able definitely to see me. You'll probably see my little logo holding the gun, but it's you can go on my bio, click on there. There's a way to be able to fill out a form, put in your information, and I'll be able to reach back out to you and answer any questions. Oh, I'm available for a DM. My information is on there as well. You can find me on LinkedIn, Darwin Roman, on Facebook, Darwin Roman. You'll find me on any social media platform, and I'm always accessible. And even if I can't help, I can find somebody that can help you as well. And also, I'm not just licensed locally here in New York, I'm licensed in multiple states.
What states are you licensed?
So I'm licensed in New York, New Jersey, Connecticut, North Carolina, Florida, recently Texas, and recently Washington.
Wow.
And also, I forgot, Missouri.
Were you in another state recently? Where were you?
Texas.
You were in Texas getting licensed?
Yes.
Okay.
I happen to be, so I know somebody that from Jersey moved to Texas. And I said, hey, I'll be visiting in Texas. They go, great. I'm married now. I live in Houston. I said, great. I'll see you there. I'll be in Houston as well. She said, great. Matter of fact, I need some life insurance. We started a trucking company. Great, no problem. So she said, please get your license. No problem. So I got my license, and now they're becoming clients.
So 8 states.
8 states,
That's
yes.
Awesome. Yeah. All right. You heard it here first. Hopefully you've been of service. It's not all about making money. It's also how do you preserve the money. It's not only about starting a thriving business. It's about how do you leave your legacy to people after you, whether God forbid you pass away, or God forbid you want your kids to carry it on. And hopefully we've been of service, and that's what we always we always plan to be of service. That is like the main thing we have in common. So thanks, and see you next time.